Well, we're actually heading into something, disinflation definitionally, but maybe even deflation is the opposite, at least for the time being. Inflation is the end game. It has to be because there's no way out from under the debt. But right now, and people are still worried about inflation. Prices are still going up. I put gas in my car just like everyone else. So I'm well aware of it, eggs, bacon, et cetera. But inflation has been coming down steadily since June of 2022. So about 7 months in a row, 8 months in a row. It peaked then. We all know what gas prices were doing and so forth. But the reason is kind of interesting, and it does go to the book and the supply chain disruption. Inflation, nominally, prices are going up. Okay, so that's inflation. But it can come from two sources that are opposite. One is from supply side shocks, supply chain disruption. That's what the book is about. We saw that in 1973 with the Arab oil embargo over the Arab-Israeli war at the time. The price of oil quadrupled, et cetera. That was a supply shock. The thing about supply side inflation is it's self-negating. It burns itself out. So, the old saying, and it's true, the cure for high oil prices is high oil prices. In other words, when things get too expensive because of supply disruption, people can't afford them, businesses close, you get layoffs, you go into recession, and prices come down pretty quickly after that. The other source of inflation is from the demand side, and this is a completely different dynamic. We saw this in the late 70s, where prices are going up, but people have some bargaining power, so unions are on strike, they're getting higher wages. I worked at Citibank in the late 70s, early 80s. They used to give us raises without asking. They just say, here's another $20,000, because they knew that the cost of living was going up. We would all change jobs if they didn't pay us more. So, but that feeds on itself. So the supply side disruption tends to snuff itself out. The demand side inflation tends to feed on itself. It gets out of control. And then we saw what Paul Volcker did with interest rates in 1981, where he took them to 20%. He caused a recession in terms of tight monetary policy to snuff out the inflation. But otherwise, if you don't do that, that just runs away. Now, the inflation we saw in 2022, late 2021, 2022, it was real. It wasn't transitory the way Jay Powell said. The price of gasoline doubled, more than doubled, and all the other complaints you hear. The filling up your Ford F-150 pickup truck went from $70 to $140, which for a lot of people that meant they couldn't eat or couldn't go out. It was killing demand in entertainment, shopping, retail, a lot of other things, which again tends to snuff it out. So that has happened to a great extent. Starting in June 2022, that was the peak, and this inflation has been coming down. Now, it's still too high. The Fed's not done. We're going to see at least one more interest rate hike, maybe, but they're going to leave one more on the table. We'll see what happens in June. I'm not forecasting June, but I would not rule out another interest rate hike in June after the May hike. So, because Jay Powell's thinking, how many times do I have to say this? He's given 9 speeches since August 2022, August 26th at the Jackson Hole, then September FOMC meeting, November FOMC meeting, end of November a speech at the Brookings Institution, December FOMC, congressional testimony, et cetera. And every time he said the same thing: inflation is job one. We've got to get unemployment up. Believe it or not, we're going to have a recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. And until we do, and what's under control mean? Well, it's 2%. That's their goal. Well, it's come down from 9 to 5. Nice job, but 5's still a far cry from 2, and it gets harder as you go along. And they're searching for what they call the terminal rate. So the terminal rate, no one knows what the number is. I don't know because Jay Powell doesn't know, but the terminal rate by definition is it's a rate that's high enough that it brings inflation down on its own without further rate hikes. Because so far they've been raising rates and inflation's been coming down. Okay, that makes sense. And they can keep raising rates and it'll come down more. But is there a level where, we're there, now we can sit tight, the famous pause, and inflation will keep coming down? Mm-hmm. Now you don't know because it's not a controlled experiment. You can't do it twice. But they're getting close. So whether it's 5.25, 5.5 remains to be seen. But that's the terminal rate. But then Wall Street came up with this narrative, as soon as they're done hiking rates, they're going to cut them. This is the famous pivot we've been hearing about for over a year at this point. No, as far as they're concerned, forget rate cuts in 2023. Maybe mid-2024, you'll get back to you on that. But there's one wild card in the deck, which is That's the Fed's plan. So I just gave you the Fed's game plan. It's not, you don't need a crystal ball. They tell you what they're going to do. All you have to do is listen, although a lot of people don't. Wall Street makes up their own version of that. But the idea of rate cuts following hitting the terminal rate is, well, rate cuts go down, so dividends look higher, so buy stocks. Wall Street is always buy stocks. That's always the punchline. But they might cut rates late in the year, not because it's their plan, not because they want to, but we could be in a very severe recession. And at which point, because the Fed's always late, they're always following the market. They never lead the market. If they've already raised it, let's say they may already be at the terminal rate, not know it. And so if they keep raising, which I expect they will, they may throw this economy into a very severe recession, at which point they may have to cut rates, not because it's in the playbook, but because unemployment goes up to 7%. But that gets back to the first question, Constantine, which is what's next. Disinflation may be deflation. Well, we actually had a pretty good track record of cutting spending for the first 220 years.
Right.
Alexander Hamilton invented the government bond market. And the debate at the time was, the United States is formed, we have a constitution, George Washington is sworn in, but we had all these Revolutionary War debts where we issued all these IOUs to fight the Revolutionary War. And they couldn't be paid. So the question is, what do we do with the Revolutionary War debt? So the Congress naturally said, screw them. We're not paying that. That was a different country. We're now the United States of America. It's the American way. But Alexander Hamilton said, no. Here's what you do. Borrow more money, pay off the debts. You'll have good credit. And when the new money comes due, you can borrow more and pay that off and just keep going. In other words, your credit is more valuable than writing off a bunch of creditors at one time, because you ruin your credit. Mm-hmm. So he said, borrow more and establish your credit, and then just keep it going. And that was the creation of the government bond market, and it's been going strong for 230 years. But I studied this, and the pattern was very consistent. The United States would run up the debt to fight a war, every war. War of 1812, obviously the Civil War, the Mexican-American War, Civil War, Spanish-American War, World War I, World War II. Every time we ran up the debt, we fought, we paid for the war, won, and then after the war, we took the debt back down again. So it never went straight up. It's not a straight line from George Washington to Joe Biden. It's a sine wave, up and down and up and down. We did a very good job of paying off the debt in times of peace. So you'd have dry powder in effect, so you could run up the debt in wartime. And that's why there's so much confusion about John Maynard Keynes. I believe Keynes was maybe the best, or second or third best, after Irving Fisher, maybe, economist of the 20th century. Mm-hmm. But Keynesianism is bankrupt. Neo-Keynesianism was really bastardized by Paul Samuelson at MIT after the war. World War II. Keynes died in, I think, 1946. So Paul Samuelson and others, the big brains at MIT, they had spent World War II as logistics experts doing linear programming. This is before computers. They had some machines, but we're gonna have D-Day. Okay, where are the supplies coming from? Where's the fuel coming from? Where's the ammunition coming from? What's the best way to deploy bombers, etc.? And they solved all those problems. So then in peace, they said, well, we can take all those wonderful tools we developed to win World War II and apply them to economics, and we'll start with Keynes, but we'll actually turn it into a machine. We can fine-tune the economy. I remember the phrase in the 60s. No more recessions, they used to say, because we can fine-tune the economy. That was all before it ran off the rails in the 1970s. I don't blame Keynes for that, because he was not an ideologue. He was a pragmatist.